I'll give it to you. I forget that shit every time, brother.
Right, we're recording. So yeah, so those of you who want a look into the ISC MSU video, if you cannot wait until tomorrow evening, it's there. Those are the key steps that we're looking for. If you have any questions, just let me know. Right, so if we get an external liquidity sweep, can we trade off the back of it? So look, it's a difficult one, that one. Yes, you can. It is possible to trade off the back of it. There's obviously a higher risk because you're basically, I mean, it depends on how you use it, because if you're waiting for something like an MSU setup to happen, so let's use, for example, this one. Okay, this is our move on Friday. So external liquidity sweep. If you're waiting for an MSU setup to happen, then we're not really just trading off the back of external liquidity. All we're really doing is we're just looking at, you know, that is effectively an ISC MSU setup, a messy one admittedly, which is why I missed it, but it is ultimately an ISC MSU setup. If you were trading just pure price action, the way that I would trade it, and I have done this before, I just like the confirmation entries these days, is you would take a really tight stop and aim for a really short target. So something like a 2R, and you're just banking on the fact that you're right at least 50% of the time. Now, if you do this, it's not a bad strategy. You're looking for key external liquidity levels. Okay, so any liquidity level that's swept, and as soon as it closes back above, you're going to be entering tight. So this one obviously would have failed, okay, because it came down and took us out. Do you get your 2R out? Do you know what? Actually, no, it wouldn't have. You would have got in and taken 2R out of the trade there, so you'd have been all right on that one. Depends on how tight you caught that entry. This one down here, this one would have been fine. So you can get in on that one there. Okay, obviously you might catch it late, for example, so you might get in late, but you know, on this one you're absolutely fine again. So if you're using extreme liquidity levels, okay, and we're just literally talking about external levels here, I'll label them up so you can see them. Okay, so we are just talking pure external liquidity levels, and you enter as soon as you get a close back within with a nice tight stop. Yeah, it's not a bad strategy at all. Okay. If you want to trade it, then you need to test it. Certainly on this section of price action, it's worked out really, really nicely, as you can see. Let's say you do that, nice tight stop, 2R there. You'll need to play around with the numbers. I'm not sure what the numbers are on it. This one, for example, would be a really wide stop, which is why, again, once you've got the close back in, you want to obviously close back in. You want to have a nice tight stop on it. You will get stopped out from time to time because there will be situations. There'll be situations where external liquidity is taken, like this one here. Okay, external liquidity is taken. You enter in off the back of that, and then it gets stopped out. So you need to be really clear on how you trade it, what the rules are around it. It's definitely one that you can go ahead and test and see what you get out of it. It is, you know, just really kind of a shoot and hope strategy. You're really just wishing that it hits that 2R, and look, as you can see, in most cases it has hit that. What it works out long term, I don't know. Let's go back and have a look at some old pricing and see if it works out back down here. So if we're looking at external levels as well, external level there, yeah, do you know what, it might not be a bad strategy. Might be one that we need to test and see how it works out, guys. So if you are going to be implementing it, just make sure you're implementing it on, you know, demo trades. So this is a good example, okay, of where it would have failed on you. So you get the close back in, don't really get a close back in. No, actually, this one will be fine as well, because you don't really get a close back in until this section of price here, and then you can see obviously it goes up to the 2R. So yeah, not a bad strategy. It seems a bit crude.
I'm not sure if the person who asked the question actually meant to exclude the MSU.
Well, if we're not excluding the MSU, then it's just the normal setup.
Well, no, he said a sweep of liquidity with an engulfing pattern after. So
yeah, no break of structure, I don't think.
No break of structure.
So just
you want two breaks of structure, right? Check.
It's not necessarily a bad setup because I use it for entry. My entry is that a candle that that takes out the liquidity, if we then see that close back within the range of the previous candle, then you know that it's signaling that the price is rejected. And then if you get an engulfing followed after, that's what I enter on, but also I use the MSU as well. So because sometimes you don't always catch that first engulfing candle, so it's nice to have that backup if it does start to break down in your direction. It's extra confirmation. It's actually a better trade, really, it's safer, but it suits my lifestyle. It's different for me than it would be for someone. If someone can actually be at the charts and be patient and wait, the MSU is obviously the better option. But I'm on the go and I'm working and stuff. It's different.
And I suppose that's really what it is, because look at this setup here, right? So you've got your external liquidity level there. So what we why did I do that?
Excuse me. Are you looking for that the engulfing on the 1 minute or the 5 minute?
There's no.
Jake?
Oh, sorry.
I'm entering on the 5 minute, so the engulfing's on the 5 minute.
Okay.
Yeah.
So
thanks.
This is what I'm looking at really here. Okay. This is why I don't think. I mean, look, it may work if you want to be kind of just in and out of the marketplace nice and quickly. Then it may work for you. But what I'd say to that is this. So we're looking at here. That's clearly an external, a key liquidity level there, because it's sat on its own in the middle of nowhere. Those are always ones to pay close attention to. We've had a close back within. Okay, nice engulfing pattern here. For me, I'm looking at that thinking, do you know what? I don't actually need to take this trade. And I'll tell you why, is that most of the time, that for this, because you're just literally hoping, effectively, you're taking the risk and then you're hoping you've got no other confirmation. For me, the way I would trade it is I would take 2 hour and be done. Whereas if I can see here that actually I've got an MSU setup, that for me now is a much more valid trade. I know that I've got manipulation, multiple points of manipulation in the marketplace, and I'm going to be entering that, and I'm confident enough with that setup that I can then hold it. So I think if you did want a crude entry where you're literally just looking for an external liquidity sweep, then an engulfing, I don't think it's a terrible setup by the looks of it. So you've got an engulfing there. What it looks like long term and how it operates, I don't know, because I haven't tested it personally. But there definitely looks like there could be something there that's worth playing around with, because I've been drawing these on kind of randomly, admittedly, but not many of them have lost. So it's definitely one that's worth testing. I might even include it in my current back testing run and just label it up for you guys on a 2R basis and see what they go to. But we'll go from there and we'll have a look at it.
Chris, just to follow up to that question, if the external liquidity points are so profitable, because in your course, when you've done it just randomly, I think you had 7 profitable external liquidity points and 3 that lost. So if the external points are so profitable, have you ever thought about looking at, I don't know, 6 pairs, 10 pairs, but just picking out the really obvious
so
external points?
I used to trade multiple pairs. Me and Jake used to do it quite regularly, where we would have what do we used to trade, Jake? We had Euro USD, GBP USD, Aussie USD, Euro JPY, GBP JPY. There was we had about 6, didn't we? That we all kind of changed.
And USD CHF, I think.
Yeah, USD CHF. Oh, USD CAD, fucking that bitch. USD CAD. I used to hate that.
It sounds like my pairs, check.
So as time went on, when you're day trading, you have to be so in tune with what's happened in the marketplace. You have to be so in tune with the pair and its individual movements. Yuri, I don't think you were on the meeting the other day, but I think it was a couple of webinars ago, we were talking about Euro USD, and I said, I reckon I can pretty much draw Euro USD from memory. And
I saw that episode.
Yeah, you did. Yeah, I did a pretty good job. And that I think is a really important understanding, that you need to be really in tune with these pairs when you're day trading, because you need to know where they're going and where they're likely to go. Now, if you were going to be trading a external liquidity sweep only strategy, that would be more of a swing trading strategy. I think there's definitely some legs in that, but you'd be, I think, having to use the much higher time frames, because if you look at a day trading time frame, so for example, a 3-minute chart, you're getting external liquidity sweeps happen all the time, and I've personally found when I was managing more than one or two pairs, I found it became really confusing, really difficult to manage, and I ended up forcing trades or missing a trade, then trying to find something on another, and it just became really confusing. So a lot of traders that I know who trade on very low time frames, over time they gradually reduce and reduce and reduce until they end up with only one or two pairs. So I think there's something in that. It just becomes too confusing, and often pairs conflict each other. So let's say I used to trade Euro USD and USD CHF until very, very recently, but then I found out I was just taking the same trade on both pairs in opposite directions, which was great when they both won, but terrible when they both lost. And for me these days, because I'm gradually building my portfolio again after I lost a load in my Forex funds, for me these days it's all about protection of capital and making sure that whatever I'm doing, I'm protecting my capital always. So the lower the risk I can have, the better. You might be really successfully trading 4 different pairs, for example, but as you've seen in the backtesting sessions, you can have 3 or 4 losses in a row. Imagine if you had 3 or 4 losses in a row on 3 or 4 different pairs. You're now up to maybe 20 losses in a row. And unless your risk profile is really, really low, you run the risk of blowing all of your accounts. And if, like me, you've got your accounts chained together, so I use a website called, service called Social Trader Tools, where I have 2 different accounts effectively that manage multiple different accounts, and I trade on them separately depending on how I manage my risk. If that makes it's very complicated, but we'll talk about it another time. But long story short is I could take those trades and I could end up blowing hundreds of thousands potentially of capital because I've had a bad run on 3 or 4 different pairs. So it really depends on your risk profile. It really depends on what your appetite is. I think if you've got an absolutely banging strategy where you never lose more than 2 or 3 times in a row, and you can show that over multiple backtested data, then great. That might be a way to do it. But the problem that you run into when you're trading multiple pairs is losing streaks. And losing streaks along with psychological battles when you have those losing streaks. So FOMO, revenge trading, greed, increasing risk, moving stop losses, those sorts of things as well. So that's one just to be cautious with. What I'd say to you is this: as a trader, we are desperate always to try and make money. And we're desperate to make this money as quickly as possible. Sometimes, and I used to have this, sometimes I'd look at, say, a week where I've won $500 and I'd say to myself, that's a shit week. When actually, when you look at that over the month, that's $2,000. That's a wage for somebody. But if it's not $5,000 or $10,000, we kind of, because what we see on social media, we kind of beat ourselves up and say it's not enough. We're so desperate to make money as quickly as possible in this industry, when actually it's going to take a bit of time. Like any career, if you start a new career, it's going to take a bit of time to build up that capital and build up that earning pot. And I think we always try and run before we can walk. So I did it. I had loads of pairs. I was trying to get 10, 15, 20R trades all the time, and it just stopped working. I just lost. And I look back at it, I just lost and lost and lost all the time. And then I tried to get really good at 2R. Jake will probably remember, this is years ago now. Do you remember when I changed my risk profile down to 2R? And I had like the most amazing week where I was just winning and winning and winning, and my strike rate went up and up and up. And what that did for my psychology, because I wasn't now chasing a 5 to 10R trade. I was chasing a 2R trade and taking my profit out. And it felt fucking amazing, because here I am now winning over and over and over again. And what that feeling does, that feeling of winning and being successful, is fucking amazing. So if you find that you're shooting for 5R, 10R trades and just losing more than you're winning, I would say don't try and run before you can walk. If you are learning to play golf, I think I used this analogy the other day. You don't go and buy the most expensive set of clubs and go to the most expensive golf course in northern Scotland and go and try and play off an 18 hole that the professionals do. You get a cheap set of clubs, you go down the driving range with your mate, and you try and hit the ball straight. And the same thing applies here, I think. Pick 1 or maybe 2 pairs if you do want to, because I appreciate why you might want to be a bit busier, but pick 1 or 2 pairs that you think you're going to be, attuned with, or in tune with, should I say, and then just try and get 2R out regularly. If you can consistently get 2R out over and over and over again, then you can start increasing your wins, and then you can start increasing your risk if you want to. But I mean, if you can get 2R out 4 times a week and do that 1% per trade, you're making 8% per week. You don't actually need anything else. So the power is in the small, consistent wins rather than the big wins. And multiple pairs, I find, are more damaging than they do good. Thank you for your question, though. It's a good question. So
Can I just interrupt? Just going back to the previous question with the sweep and then engulfing candle, I've actually got my markup still on my chart from previous. Do you want me to show it?
Yeah, definitely. Wait there, let me just stop the show. I can never fucking get off. Once I've hidden this panel, I can never get it back. Come on, there he is. Right, all yours.
I don't do this shit. No, I don't know what I'm doing.
I think I've got to allow you access. Oh, you got it?
Did everyone see?
Oh, your screen looks nice for once.
Yeah, this is what I see, not when I'm. So yeah, that's a sweep, and then what I said before. If I just.
And you're just doing this on 5-minute engulfing, are you?
Yeah, I'll show you 2 seconds. Go back on replay.
Do you have any criteria on which liquidity levels you take?
Yeah, so like I'll do it on ones like these. So this is obviously a 30-minute range. This.
Yeah.
Not there, obviously. There.
Yeah.
I'll take that one, but I didn't take that because it was 7:20 at night.
Yeah.
And then the higher up one as well. And then sometimes if I'm seeing that bearish momentum's just continuing, then I'll happily try and get involved in something like this where it's just a clear sweep. Yeah. And then a big engulfing on the way back down again. Like that was just break-even trade, but doesn't really matter.
How many like candlestick patterns are like? So many of them are just absolute bullshit. The engulfing pattern is the one that is so good in it. Like it shows
the best
momentum.
One, yeah.
It shows momentum. It shows a change in direction. You know, when you go into the lower time frames of an engulfing pattern, you'll have a reversal pattern in there, and you'll have a sign. You know, you'll have a clear move away. It's such a good little pattern. It's one of the only things that I've kept from pure retail trading that actually still works.
Even if you just look at just this section here, right? You've got all these wiki green. So these, this is the MentFX Triple M indicator. So for people that don't know who MentFX is, he's another YouTube educator. Me and Czech were on his course for a long time, and this basically is it's a free indicator. And every time you see a red thing with a sell candle after, or a green thing with a green candle after, green will mean there's a fractal accumulation happening there. So because this is on a 5-minute chart, the accumulation could be on the 30-second, 15-second, so it's very, very broken down. But you can see all these fractal accumulations with engulfing candles after, but they lead to nothing. And then the red candles with the big engulfing candles, these ones are the ones that are actually signaling the orders and money coming into the market. These wicks don't really mean anything. This one is the one that actually shows its hand. So I didn't obviously take that entry, but got involved in this one, and then I'm going to exit this because I'm not going to watch that play out. That
looks like a classic range liquidity move as well. That little push down before the full external. Yeah, so that one,
that was, I closed this like down here because that was just the part of the challenge I was done, so didn't need to hold that. Then I'm playing in tight ranges here, but it's all basically the exact same thing. And then you get some hefty ones that can just go as well.
Nice.
This one, I knew this liquidity would play a part, but I was always bullish on it after mitigating much higher time frame zones. So it's all just the exact same thing, and that's just the thing I use. But also I use the MSU as well, but I don't need to show you them because Czech's shown you plenty.
Very nice.
So yeah,
it looks nice.
Back over.
I think it's definitely worth mucking about with. I'll tell you what I'm going to do.
You've just got to be really patient with it. If you're taking these, rejections and engulfings everywhere, you're going to lose. It has to be in the right areas after taking the right liquidity. It can't just be in the middle of ranges because you're just going to get swapped out all the time.
Right.
How do I stop? Ah, there we go.
You're going to keep talking for a minute because I'm just doing something.
Has anyone else got any questions? Does anyone want to know anything? Not necessarily a question, but is anyone intrigued about anything that they've read or seen, or any of Check's videos that they want clarifying?
Yeah, Jake, I just wanted to ask, your entries, are you taking them strictly on the 5 minute then? As soon as you see an engulf close, are you waiting for closure, or are you just doing it halfway?
So if I know I'm because I'm at work, if I can see a candle is really pushing down, and there's about a minute left, I probably shouldn't, but because I'm trying to crack on with my actual job, so I'm a self-employed carpenter as well, so I'm running around doing shit all the time, sometimes driving. So if I'm like about to get in the van, for example, this has happened before, so I may as well use it. There's been about a minute left and I need to crack on. I need to go to the next job or whatever.
Yeah.
I'll just enter, but only if it's like if it's an engulfing candle, but it's only just below the previous candle, then I'll just firm it out and wait, because sometimes that can just close up above and then it can play around for a bit longer and then the actual move happens. So, but because it's on the 5 minute, if I wait for like a candle or two and nothing's really happening, I'll just risk it. But I shouldn't tell you, but I mean, I just drive with. I just have it on my speedo thing. I'm just watching that. I'm not doing nothing with it. I'm just watching it.
So your advice is to wait for closure, but sometimes you can't because obviously you're busy, innit?
Yeah. So if I could, I'd always wait for closure, because closure that signifies something bigger.
Yeah.
But if it's like a bar and a half with a minute to go, you're safe pretty much.
Yeah.
I hear you.
Yeah, you can sort of get a feeling of the market if something's gonna go your way. Like, for example, where Check is now, the last push down, say it was the last engulfing candle down, say it was down below the white candle, I'd just be like, yeah, I'll take that. That's fine, and just accept the wider stop loss.
Yeah.
All right, should we test it? Should we play around with it in the time we've got left?
Yeah, go for it.
How many pairs do you trade then, Jake?
I literally just trade GJ.
Okay, just the one, yeah? Okay. Thanks, mate.
That's why I can get involved in. You saw all those trades. There was the big ones, the ones that took external liquidity and dumped down, and you get. Like, for me, I just take partial at the first liquidity point, which it varies. Like Check says 2R, but sometimes it can be 1.7, sometimes it can be 3.3. I have absolutely no bias about what it is, but I'll go break even at 1.5R every single time, and that doesn't change. That's just my strategy. That's just what I've tested, because I like to keep things simple. Like I said, with my job, I can just set an alert at 1.5 and I know that it works. So,
with your job, I could see you try to juggle three pairs at once.
It's like, and I used to do that shit on the 1 minute, and I wonder why my brain. I used to, yeah. Yeah, and like I wondered why I wasn't profitable, and now it's so blindingly obvious.
You had FOMO and everything else going on.
yeah, stupid. Like, I mean, I'd go on crazy runs where I'd make like 20+% in a month, and then I'd just lose everything over and over and over again. Proper boom and buster. But to just carry on with that question, that's how I can get involved in those much tighter ranges as well, rather than just waiting for the external liquidity all the time. If I've got a narrative on a pair, and let's say, for example, I presume it's going to go bullish, then I haven't always got to wait for the external sweeps, because, as you know, they don't always happen, and the continuations can sometimes just carry on from anywhere. So as long as there's some form of liquidity sweep going on, I can be looking at the 5 minute and see it just going sideways, and then a big move down, engulfing straight after. I'm happy seeing that as a reaccumulation and taking that. Go for it.
Right. Nice.
So what are we doing here, Check? What are the parameters? What are the rules?
Don't know yet. I'm just playing around with it. I accidentally selected a $1 million account, so I don't know if you can see, but I just made 21 grand, boys. Fucking 21 grand. Get in. I'm looking for a clean close on the 15-minute. I'm going to be using hourly external levels. I'm looking for a clean close on the 15-minute. Is effectively a rough. I'm kind of spitballing right now.
Okay, and just going to 2R, taking that and leaving it?
2R, and then be done with it and just see where we end up effectively. Right.
So what's the overall market doing now? Like, can we zoom out a little bit and just get a daily bias or whatever?
Bearish
Bearish for the...
Yeah, clearly bearish. Right, so this technically then made a close back in. So I've missed that trade, but that would have been a loss. We've closed back in. Let's just take that one. Let's do a tight stop. 2R here. Doubt this is hold because it looks so bearish. Yeah, okay, that's dead.
So we know we're bearish, so why are you trying to take longs? It's just from that liquidity.
I'm just literally just using external levels. Because this is what, if you were just using an external level, this is what you'd be looking for, isn't it? External levels here and here.
What about if you only look for bearish sweeps though? Because if you know you're bearish, then trying to catch bullish plays is...
I want to see how it works. I want to see it works if there's almost just like an automated, just literally an automated. Because look, if you can get 2R and you can win at least 50% of your trades, you're laughing, aren't you? Dead. So you're saying just look at.
Yeah, I mean, if the overall narrative of the market is bearish, then you'd be looking above those highs right there.
You would. The thing is, though, these external levels, though, if you're just literally trading off the top of them, I haven't taken this trade, as you can see. Are we saying that once the level's been taken, it's done because the liquidity's used up? So again, it's like looking at that, isn't it? So what you're saying with in terms of that level. Okay, let's see if we can get an external one on the bullish side. So we've got new range there. So let's use the range finder, it's probably easier.
Yeah, so now you've had a sweep, but you haven't had an engulfing. Still not, that wasn't a good engulfing there.
No. That was.
Okay, so that's market open, isn't it?
Was that Sunday?
So is that how you set this all up? Is it you just place the tool and then click place order?
Yeah. That one died.
Yeah, so now it's taken the proper liquidity there.
Yeah, so now we've got a big engulfing there. And see, this is why I don't really like a strategy like this, because we're not really including any other theory, are we? We're just literally saying, right, external level taken, let's take the order effectively.
Well, but I mean, it is including the theory of the price is moving from liquidity to liquidity, isn't it? So it's actually
there's equal highs to the left of there that you wouldn't get into it until there's equal highs.
Yeah, and if you were trading those 1 hour levels, 1 hour and 15 minute isn't quite a very good. It's too much. It's too close of a time frame. Do you know what I mean?
1 hour 5 minutes, probably better.
Yeah. So if you were just looking at 1 hour levels and then you looked at the 5 minute chart, you'd be hitting your either break even or your 2R much easier. Oh yeah, it's gonna happen. Okay.
So what we're saying, we don't need to close. We don't need to close below. We just want, or you say.
So now what I would be doing, it's annoying because actually I can draw on your chart. Pause it.
There
So
it is.
you would have entered there.
So no, so then right. So now I know that this level here is key. So now I'm watching this range and what's going on here, because now I see this range. And now I see this range, and then that liquidity sweep, then the engulfing candle. I'm gonna get in. Oh, I can't. Oh my god. Now I'm gonna get in at that engulfing candle there with the stop here.
But even though we're above the liquidity level.
Yeah, because like if you then go onto the 1 hour, that's a 1 hour external liquidity, isn't it?
Yeah.
That's a straight drop.
look, that whipped the liquidity, went up, another candle, straight down. So actually, if you're looking at it in the 1 hour, it didn't spend longer than 3 candles above it. So you're just playing that inside range right at the top of the liquidity. It has to take that time to do that sort of move, doesn't it? So if you then place the entry where I would have placed it, check, and let me just clear it. It's like right there.
Right. That's
Then,
what I've seen.
and I'd have my stop higher than that and just give it a little bit more breathing room.
Yeah. Might be something there. It's definitely worth playing around with.
So you have to be clever. Sorry, Jack, I'm going to draw again. So can you just go back on the 5 minute? Cheers. So you watch price here and you're like, okay, we've had a rejection there. So you potentially you get in there and you have your stop up here and then you take a loss and you're like, okay, don't go crazy and be like, oh, I need to get back in the market. I need to get back in the market. Just watch and wait, and then you see something like this happen and you're like, okay, what normally happens when something like this happens? Like you see it all the time, so what happens when something like that happens?
Jake makes money.
No, so not at all. Not a retracement. Well, a move will happen because price is doing this and consolidating orders, and then we either see a move up and then down, and then sometimes straight back up again, or a move up and then down, and then we continue down. So this would be a reaccumulation and this would be a distribution. But as we're in a bearish market, if it's going to distribute, it's going to do something like that. Does that make sense?
Yeah, makes sense.
You're basically playing a much smaller range after the external liquidity is taken. Yeah. So
I just don't like the idea of just entering off and engulfing. I just feel like there's not enough confirmation for that move because that's an engulfing. You could argue that's an engulfing. I'd be nervous about taking a trade just off the back of an engulfing.
Yeah, but I'm not though, because I'm taking the trade off of the back of the engulfing, which a new range has been created. It's been swept, and then an engulfing has happened after taking external liquidity. The market is bearish, and then we're seeing something like that. Yeah. So it's chucking everything in, isn't it? Yeah. That's just the entry pattern, but there's so much more that goes to it. That's why I was saying, why are you looking for bullish plays when the overall market is bearish? So I know that I'm only looking for a sweep of one side of the market to then continue on in its given direction.
I suppose, but then we're turning this into a whole trading strategy. And I think the question earlier came from the basis of, look, what is the profitability of literally just every time an external level is swept, taking a trade off and engulfing, and therefore it would be buys and sells all the time. I think there's clearly something there that is worth testing out. It's not something I've tested fully. It's not something Jake's tested fully. For those of you who are interested in it, look, we'd be open to hear the stats because it's easy to see the charts and draw on these lines and draw on your trade tools. But as you can see in live market conditions, it's a whole different machine. And if we are just purely looking at external sweeps with engulfing patterns, I think like Jake's quite clearly shown, there's so much more that needs to go into the market and so much more that needs to go into your trades before you can use those strategies. we've just been cut off. That's the end of the Zoom. Thank you for tuning up, guys, and we'll catch you guys soon. Cheers. Yeah, the point I was making before we got cut off is, yeah, Jake, I know you tested your strategy, but from a pure external liquidity point, just trading engulfings, that's not enough. I don't think it's enough, and I think in live markets you're going to get loads of false moves, which are going to trick you into trades, as we saw there. I think when you add in theory and structure and, you know, momentum, like Jake has done and has tested, then you will get different results. But the question that was asked is external liquidity levels and engulfing patterns afterwards. The answer, I think, is very clearly that we need more than just that. I'm gonna test it as a raw strategy and see if there's something on it, because you never know, we might be able to build a bot out of it. It might be quite cool one.
I was thinking, because there's sites online, isn't there, that have like sentiment viewers, so that you can see the daily and stuff like that of, you know, what the price action is actually doing, or what they presume the price action is doing. You could incorporate that, and you could just have it as like a much higher time frame one, couldn't you? Because if you're going to get a sweep and an engulfing on a much higher time frame, your chances of getting 2R are probably better, because a big move like that has to have some substance on a higher time frame, doesn't it? So yeah, it might not be a bad idea to think about it.
It might might also be just like a one time frame strategy. It might be you look at the 30-minute chart or the 15-minute chart and you just literally trade that time frame. You don't trade any others. I don't know. It needs playing around with. There might be something there. You know, if you can get 50% of your trades winning at 2R, then you've got a really profitable strategy at the end of the day. You can do 4 or 5% a week easy.
Especially one that you don't even have to control.
Yeah. Yeah. So,
Check, can I add in something?
Yeah, of course you can, Matt. Yeah, I'm interested to see these details.
When I first joined, I actually went and back tested Euro USD on FX Replay.
Yeah.
And I just strictly did external. I also did range as well, but I didn't do anything else. And I back tested it from like start of July of 23 to like October, November.
Share your screen, brother.
I'm looking at the stats. I don't have I just have the stats. My chart was completely wiped because I didn't know how to use it back then. But I ran up. It was 209%. I had 47 wins and 7 losses.
Shit.
And that was strictly off of external sweeps.
Yeah.
And it was both sell side and buy side, but it was more so based off of if it was, let's say we're in a bearish market, my sells were going to longer R's. If it was a little bit of a reversal of external, it was quicker profits out, because we don't know how high it's going to go.
What were your entry criteria?
But it was range external. The entry criteria, it wasn't, I think it was still an MSU, but sometimes I found that you could just go off the back of an engulfing on just the higher time frame.
Like a risk entry engulfing. Nice. That's amazing.
Yeah.
Can we see the stats? Have you got them there? Can we see them?
No, I just have the number. I wiped my chart on on TradingView, and then it's not on here. So I can do it again.
Definitely. I think,
but again, it's good.
I was going to say, I think, you know, if you've got that from a couple of months ago, the way you are now, and with the other things that we've learned recently, I think, you know, it's only going to get better and better. And this is the beauty of your back testing, is that each time you do what I call a pass, so you go through, you complete a pass, maybe that's like the last year or the last 2 years, you go back and start again, you could trade the same price action and you'll get better results. What normally happens is you'll trade less, so you'll take less trades and you'll win more as a result of that, because you've learned how to take losses. Now, once you've got a good strategy, you'll always take the wins generally. You'll very rarely miss the wins, because the winning trades are always the most obvious of trades. What you get good at is cutting out the trades that have lost or are likely to lose or may lose. And as a professional trader, you'll get better and better at that. And you find you just become more and more selective. And the ones that you do take usually win more, and the ones that you don't take normally end up being losses. So it's definitely worth going through again, Max. Like, I bet you get better stats. Do you say you had out of 200 trades, you only had 7 losses?
No, it was 47 wins, 7
47.
losses.
Shit, I was going to say, kids are fucking genius.
I've got a question about that. So obviously that's just your entry criteria, but what's your risk management? So how much are you risking per trade? What's your profit target? How far is a stop loss from entry, or like what, you know, There's like that.
Yeah.
They're like quite key rules that people might be interested in knowing.
Yeah, some of the rules were the stop loss was put at the highest point, obviously, to where we had the engulfing candle. So you just put it a couple pips above there. This was on a 100K account, so I was risking, I believe, 2%. Obviously, knowing now, I would only go like maybe 1%. You go even lower than that. But when you hit 1R, you would take half out. Don't move your stop loss, because technically, if it were to go and hit your stop loss, you'd pretty much be at break even.
Yeah.
So there's no point. When it hit 2R, you would take another 50 out. Then you would go to break even. Then you would hit 4R, 6R, and then you could leave a runner. Obviously, your money would be lower as it went down. But with the external sweeps, you were hitting. I mean, there were trades going to 10R if you just left a runner. It didn't happen all the time, but that was just off of external and range.
Amazing.
And then obviously if you're in a bearish market and you're catching the reversal off of an external point, your profit like 80% on at 2R, break even quicker, just because it doesn't need to go as far back up, because it can just shoot down. You're in a bearish market. So
really cool.
Yeah,
So Matt, was this a 1 hour external?
I was toying with around, I want to say it was 1 to 2 hour if it was a clear one. If there wasn't a clear range, I would move up to the 4 hour. I think that was the highest I would go.
Higher time frame. Okay.
And then entries were on, honestly, whenever you really see a good entry. I would say maybe 15-minute would probably be the lowest I'd go.
Yeah.
Just because,
Thank you.
That was a good price action. Yep.
That's I think a really important differentiation as well, is that you want these liquidity areas to be the highest time frame possible, which is why I love it. I love a daily sweep, for example. Daily sweeps are fucking amazing because they carry loads of weight. It's not just the liquidity that's sat because of the normal day's trading, but also liquidity sat from people that trade on much higher time frames. They typically will use these daily highs and these daily lows, which are amazing. So the best thing that you can do as a trader is try and find daily levels or 4 hour levels, because they usually carry more liquidity, and then get in the lowest possible time frame entry, like a 1 minute or 3 minute entry, and that's how you can really catch the big trades. I'm not fussed about a big trade because I take most of my profit off early anyway, but if I can get my 2R out quicker, then I'm laughing. The perfect trade for me, like on, I think it was Wednesday, we had that really nice buy on Euro USD. Had a lovely buy on Euro USD. I took my profit out within an hour. So I was like 70-80% out of the trade. I can't remember how I managed it exactly. I was 66% out of the trade. I took 2/3 off, and the rest was left to run it. It went to 8R in the end, which is fucking amazing. But I took my profit out within an hour, and then I can just crack on with my day. So for me, I'm looking to take my profit off as quickly as I can. So if you use these higher time frame liquidity levels, you're going to get better trades, more successful and reliable trades as well, because if you have a good reaction to a 4 hour, like Matt said, or a daily level, then these reactions will usually cause bigger moves. If you're just looking at like 15-minute levels or 30-minute levels, this is where you can get really confused. This is what can get difficult as well, because if, like Jake and I, you're trading one pair, you might not have one of those levels taken for a day, or maybe 2 days. Some days or some sessions, you might just sit there and do nothing for like 3, 4, 5 sessions in a row. So patience is really, really key. I'm not a very patient trader, which is why I've built a strategy on being able to trade quite regularly. But the higher time frame levels usually have more liquidity sat around them, so they're generally the better ones to trade. So yeah.
Can I add in one last thing?
Yeah.
Real quick, just on my back testing. That really worked well with a continuous market. If you start getting a market where it's not in a clear direction on the higher time frame and you're kind of back and forth, that strategy does not work as well, because you don't have a clear bias on which way you're going. I haven't tested it with enough. Obviously, that was just I think in those months it was a clear bearish market on Euro USD. I haven't tested it quite with a ranging one, or back and forth, going up and back down. So that was just in a clear bearish market, and it worked well. But if you don't have that, I don't know how well it is.
Ranging markets for liquidity strategies are usually really good. They're one of the only strategies that work because you're just waiting for it. And as long as you're just waiting, so like range liquidity doesn't work very well in range bound markets, as confusing as that is, but external liquidity in range bound markets is really, really good, because usually if price is stagnant, as soon as it takes out one of those external levels, it'll normally always reverse. It's a little bit like what we had on Euro USD this week. We just had external to external to external, and it just kind of stuck in that range. I think we've probably got a higher time frame bullish reversal going on EURUSD at the moment, but you know, there's trades, buys and sells up and down all week, which is why, you know, there's some quite good positions to take. Didn't take full advantage of them myself, unfortunately, but I came out with profit, which is good. It's all we really care about, and we move on to the next.
Check. Is
Yes.
sometimes a pair like Euro USD will make a symmetrical triangle for a week. How do you trade that? Do you just go to another pair? Because
What do you mean by symmetrical triangle?
So from the top and from the bottom, it just gets narrower and narrower into a central point. So it never sweeps the highs, and
Okay.
it never sweeps the lows.
It's like a sideways triangle.
Yeah, exactly. Yeah.
Sideways, yeah.
Let's have a look.
Pyramid
Sometimes,
kind of
yeah,
deal.
sometimes it goes on for like a week. If you look back on Euro USD on a higher time frame, you can find an example recently.
Yeah. Get out of FX replay.
The hardest ones to trade are the expanding triangles that get higher and lower, then higher, then lower. At least with retail, probably with liquidity, it's probably better that way.
Yeah, so if you look at that one to your left, I think it's on the 18th. Yeah, right, that one, yeah.
Here.
So that one, that one, that makes a triangle, right? Symmetrical triangle if you draw two lines. If you
What,
grab
this,
the bottoms
this and this?
and the top.
So like this and this.
No. If you grab the bottom of the shape,
Here.
yeah, from there, but drag it a little bit more to the left as well.
Yeah.
Yeah, like that, and get the
Okay.
top one as well.
Then the top one.
What, on the top here?
Yeah, and
Yep.
the top in a triangle formation, yeah, going downwards.
Yeah.
Okay.
Draw a trend
So
line
from-
on the
Like that,
highs.
yeah, yeah.
Okay.
So
Like
so
a wedge
all of that,
pattern. Okay.
yeah.
with
So
you.
all
Okay.
so all of that lasted for a week.
Mhm.
So it never swept the highs or the lows. So how do you trade this one? Do you move to another pair for that week, or
No, I wouldn't move to another pair. I might have a look at see what I've got on CAD JPY, but I've probably got. Let's have a quick look. So where's Monday? So we've got Monday here. Okay, so for me, I'm getting in on that buy on Tuesday.
Yep.
So we've got our range here. We've got discount pricing down here. Okay, we had a rejection from discount pricing through Monday. And then by the looks of it, we've got an entry on Tuesday. Okay, so we've got a nice big push up. We know we're bullish. We've taken out liquidity to the left here. We've taken out liquidity down here as well. So for me, I'm seeing my 1030 pullback here. 1030 pullback. And then I would probably wait until we've got some New York price action. We've got a New York trap here and enter off the back of that trap. So like this. Oh shit, I need that, I think. I'd be taking an entry off that. Just trading into that bullish momentum. That'd be the first thing I'd be looking at. I'll get my 2R out there, so I'm happy and I can let the rest run. In terms of will I've taken a sell there, so no, there'll be no trade there for me. Then got bull. Would I have taken anything off here? See, we've got a nice little range here as well, so there might have been a sell there. Let's have a look. Okay, so we've got daily range. And then we've got range liquidity here. So there's probably been a sell here. It's a Friday, yeah. So we've got breakdown. Sweep push down, and I probably got in again. If I didn't catch that, which I might not have done to be fair, because it's a little bit before and there was no MSU setup, I'd have probably caught the 1030 pullback instead. Okay, I think I did actually catch this trade because we had that here and we had that sweep. Yeah, I'm pretty sure I did take this trade. When was it? Yeah, that would have taken me down for my 2R down here. So within that wedge, there are opportunities. Would I have taken any of these sells? Probably not. Although, when we can see we're rejecting that, I don't really trade trend lines, so I probably would have missed that sell, to be fair, because we're stuck in the middle of that range. I'll probably be looking for more buys. On the basis that we've still got all this liquidity, I'd have been looking for more buys and hopefully would have caught one of these setups here. So we've got our Asia sweep here. We've got an ISC. Yeah, so we've got ISC there. Okay, it's a bit of a messy one, but there's an imbalance there.
You wouldn't be trading shorts there anyway after seeing it hold the low as well. It's way too risky.
Our ISC there. We've got MSU here. Let me trade off the back of that engulfing, which if you'd been, I mean, it depends on what time frame you're on, but let's say you're just purely trading the 3-minute time frame. You'd have that one there. I feel like I remember this price action. Stop above that high. Yeah, okay, so that would be my 2.8 out, and then we're out of that wedge anyway. So I think it's about picking the right opportunities at the right time. If we take away these, and this is why I wouldn't draw these on, if we take these away, what we're looking at? Well, we're looking at a clearly bullish market that's had a big bearish pullback. We've got a nice range liquidity move here, which if we hadn't caught the top of that, we would have taken that 1030 pullback trade there, holding down to discount, get a nice 4R out. We've then very quickly returned to our bullish price action. Okay, if we look at high time frame structure, remember, if we want a clean reversal, what we're looking for, okay, if we want a clean reversal pattern, okay, we're not just going to accept that first move down, because remember, we want, what is going on here? We want that first push down, then a pullback, then another push down. Okay, that confirms our bearish move. So on the basis that we've just had this one big pullback, although that is an area that we can trade in here, like we always say with range liquidity, we're not expecting that to hold, and as range liquidity often does, it hasn't held until that it's reached for that external liquidity. If I was looking for a reversal from here, I'd want that as my initial false move. So we've got this move up here, then we've had this as our initial false move, becomes false, okay, and then we're looking for a true breaker structure to really signal us into a reversal. If we are to reverse out, I'm not sure what price's action has in mind, but that would therefore be a fake move. And now I can get in on sells here if I wanted to, because now we've had the proper move, and that should then hopefully push down further. Let's have a quick look, see what it does. Yeah, okay. So that's just what's happened here is we've had ultimately a higher time frame reversal. Let's see if we take out that low. Oh, we're back up to price. Oh, we're back up to live markets. So this, for me, I'll be looking at this thinking, right, well, we have had that push down, but then, you know, you've got all this liquidity sat above now. So is this an area where we'd be looking for reversals from? Probably not. We really want the reversal from up here, ideally. And this, if you look at just, again, pure price action, we're very bullish, very corrective on the pullback. So expecting more bullish price action here. It's really difficult, Yuri, when you have loads of different strategies in your head. It's really difficult to kind of streamline them all, because you then end up confusing yourself often further, I find. And if you're looking at wedge patterns along with trying to trade liquidity concepts, you may find yourself confusing yourself inadvertently. So, you know, I would say commit to the strategy that you want to follow, and use its elements in its purest form and try and put those other things that you've learned to one side. Now, maybe things that you reincorporate at a later date. For example, I traded a purely SMC strategy, which had a very simple break retest entry. Recently, I brought the engulfing pattern back into my trading about a year or so ago after I started trading MSU. So these things might have a place at some point. They might come in and have a place at some point. Sorry, someone's at my front door very late at night. Just give me 2 seconds.
Check, can I just interrupt a second?
Yeah, Anna, do you know what that is?
Segue quite nicely because you said about streamlining your strategy. So I've just had a quick look on GJ after listening to Matt there, and if I share my screen, I'll show you what I've done. So this literally, I started just from here, just whilst Chet was answering a question, and literally just did these external liquidity sweeps on the 4 hour with an entry. So entry at the external liquidity with a 50 pip stop loss. I wasn't being super accurate. Yeah. And then targeting external liquidity. Yeah. That was it. That was the strategy. And I did it in five minutes maximum. And so you can see that one was 7. That one was 7. That one was a loss. That one was 11. That was a loss. And that one's break even. And I don't know what time period that's over. 74 days. So 2.5 months. And you would have had 1, 2, 3, 6 trades. But that's just incorporating a very, very tiny chunk of checks. Course.
Yeah, the external level.
A tiny little chunk of checks course into a strategy that if you say you didn't have much time on your hands and you couldn't be on your phone at work or whatever it was, this is how you could incorporate the strategy, because you can't necessarily be on the 1, 10, 15 minute, 5 minute, whatever it is. This is how you can incorporate it into a really basic strategy that over time can work. This is a very profitable 2.5 months. 7. Say because this is a 4 hour chart, you could risk 1.5%. If you're taking one trade every week, it doesn't really matter. If you're risking a little bit higher, you go 2%. So that's 15. That's 14. That's a loss. That's 22. That's break even. So loss, 22, 15, 50%.
Nice. Definitely something worth playing around with. Maybe something maybe use for this string strategy at some point. We'll have a look at it, definitely.
Just a different way of thinking about it, because I know not everyone is available at the charts like most of us are. Yeah. But this goes on YouTube, so this might help someone, and then someone else might join who trades a little bit different or can't trade like us.
I love it. Right, I've got to go because that person at my door is my Tesco's delivery, so I've got to go help bring the shopping in.
Oh yeah, fair enough.
Everyone's questions answered. I'm sure we've got more, but for this evening, is everyone's questions answered?
That was good. That was a good webinar. I enjoyed that.
Did that make sense, Yuri, when we were talking about the the wedge? Yeah, makes sense. Yeah. I think it's making sure that we're always acknowledging momentum and key liquidity areas. Just be careful when you're crossing over strategies, because it may confuse you more. But look,
check for next time. I'm gonna watch the New York trap videos again. There's a couple of us that we watched the videos, but we didn't quite understand it. So I'll make a note now, and I'll ask you on the next webinar about the New York trap.
Yeah, of course. Or just drop them in the group, mate. I'm always happy. I can jump on, record a quick video if you need anything explained. A lot of this stuff that I've learned has been learned over years and years and years. So it's difficult getting it out into kind of 30, 40, 50-minute videos and getting it perfect. So I'm assuming when we finish the course, there's going to be follow-up videos, kind of supplementary videos that need to go alongside other things. The other thing is, as well, is I'm also at section 4 in the course now anyway. So we will be going through the New York trap in about 2 or 3 videos time. So if you have any questions, whack them in, and then I'll make sure that those questions are answered when we get to that video, which should be recorded this week. All right?
Perfect.
Cool. Right. I'm going to get this uploaded. I'm going to make sure you've got episode 3.2 first. Make sure that's with you first, and then I'll get the webinar uploaded. They both should be with you this evening for anyone who didn't catch it. All right?
All right.
Cheers, guys.
Yeah.
Thanks for your time.
All right.
Take
Cheers,
it
boys.
easy. See you later.
Have a great day.
Cheers.
Yeah, lads.